Thinking about buying a small business? Here are the biggest red flags I see in business listings that should make you pause before you sign a letter of intent. Because sometimes what looks like a great deal is just a polished up money pit.
Welcome to Business Buying for Financial Independence. I'm Tim Delaney, and I help young professionals buy small businesses so they can escape the 9-to-5 and take control of their time, income, and future. If that sounds like you, hit the subscribe button and let's get into it.
Red flag number one, mysterious add backs. Let's back it up a second. What is an add back? When you look at a business listing, you will very often see something called seller discretionary earnings or cash flow or EBITDA, earnings before interest, taxes, depreciation, and amortization. One of those three metrics, and those are often used interchangeably in small business acquisitions, is used to show you how much money the owner of the business is taking home every year. So it's not exactly equal to profit all the time because profit doesn't account for things or doesn't add back in things like depreciation or taxes or amortization, which are non-expense related items, non-cash related items. So they go on the P&L as an expense, depreciation does, but it doesn't actually suck cash out of the business. So this metric, SDE or EBITDA or cash flow, is used in valuing the business because it shows you what the owner truly takes home. In order to get that number, what a lot of brokers will do, or business owners, if they're selling it themselves, will add back in certain expenses that they consider their own discretionary expenses that don't have any real impact on the business. An example of this could be they have a family cell phone plan that they run through the business, and all of their children get a cell phone on that, which, $50 a month times 3 kids times 12 months turns into a substantial expense that the business doesn't need that to operate. Is it legal? No, not really, but a lot of business owners do it. That's one example. Another example could be a car that they buy. Does the business need a vehicle to operate? Maybe, maybe not. But if it does not, then that vehicle expense, whether it's a lease payment, whether it's gas, whether it's mileage reimbursement, shouldn't necessarily be on the business expenses. So the seller adds that back in because it's not necessary for the business to run. It's just a choice that the seller had made in running their business. Now, these can get mild to wild. There will be sellers that will add back in tons of things saying it's not necessary to run the business. And that's where these mysterious add backs come into play. You need to take a real good look at what expenses the seller is adding back in to make sure that they are legitimately just the owner's discretionary spending that is not needed to run the business. Take a look at some of these things, whether they're legit or not legit. I've used the example of travel to a conference, an industry conference. For some businesses, traveling to an industry conference might not be needed at all, while others might say, yes, that is needed. So it could be an unnecessary add back, or it could be necessary. Maybe the level of travel. The seller's been doing well for himself or herself for decades. Maybe instead of flying the cheapest ticket that stops in 3 cities on the way to wherever they're going, they're buying a first class ticket direct. So you could add back some of those expenses, but maybe not all of them. Whatever expenses are added back, you just need to make sure that the seller has a very clear, concise reason as to why those were added back. And if they can't, then I personally would subtract them. They would not be an add back. If there's not a clear explanation for them, if there's not a clear understanding that it's not necessary, then I would be subtracting those from their add backs. The rule of thumb is, can you run the business without that expense? If you can, then okay, it's a good add back. If you cannot, then it is not a good add back. Red flag number 2, short lease or no real clarity on the real estate of the business. Some businesses are very location dependent. A retail store, a restaurant, they may have been operating in the same place for decades. What does that lease look like? Can you get a clear copy of it? Do you know that you'll be able to stay in that location for years and decades to come? That matters a lot for those types of businesses where foot traffic and customers have been going to that same place for a long time. It's why you're buying an established business, so that you already have the built-in customer base. You don't want to go buy a business and then have to move it down the street, around the corner. Not only is that moving cost huge, but now you have to re-advertise and retrain all of your customers where to go and where to find you. So making sure that the lease is clear, making sure that the real estate situation is clear. Does the current business owner also own the real estate? Are they offering you a lease? Are they offering to sell you the real estate as well? And if they give you a lease, are they putting in that lease that you have the first right of refusal to buy that property in the future, should they ever decide to sell? That's something that I would negotiate for as a business buyer. So just making sure that that real estate situation, your location situation, is 100% crystal clear before you go and purchase the business. Red flag number 3, the seller can't explain their own numbers. Very often, when you're looking at a business, after you sign a non-disclosure agreement, the broker or the seller will send you over a couple years worth of financials, usually either spreadsheets or reports from QuickBooks or some other accounting software, and also tax returns. I prefer to see the tax returns along with the books because sometimes they paint very different pictures. It's just because the accountant moves stuff around and doesn't explain it to the seller, to the business owner, of what they're doing and why they're doing it that way, moving categories around. Sometimes it's because that owner is doing certain things, whether legitimate or illegitimate, to help their tax situation. That's one area where, as a buyer, you want a clear explanation if you see discrepancies in those numbers. It's one thing if they can't explain it to you right away. Maybe they have to ask their accountant. But when they come back and they still don't have a good explanation, then that raises red flags for me. Or even when you're just looking at their books, if you're asking them questions and they cannot answer any of them, or they have kind of roundabout reasons as to why this looks like that, or why the revenue was really high this year and really low this year and went up and down, and they don't have good, solid, concrete reasons for that, then I would be a little bit nervous about making an offer on that business. Red flag number 4, they say something like, there is so much potential here, or you could do so much more with the right marketing. Well, if that was true, why aren't you doing it? Especially if they're trying to get me to pay a higher price because there is more potential, or there is so much more we could do with better marketing. Kind of rubs me the wrong way, because if that was so true and so easy, like they're making it sound, then why didn't they already do it? Now, sure, there are situations where the owners are just tired and or they wanted to use that money for personal stuff and didn't want to reinvest in the business anymore. But it doesn't mean that you have to pay for that untapped potential. You're paying and buying the existing business as it sits today, not what it could be if you spend even more money. When they say stuff like that, make sure you're asking the questions of, like, why didn't they do it? Was it the time? Was it the money? Was it just that they don't know what they're doing? Which, again, can be a good thing as a buyer if you have a plan to execute a good marketing strategy and add in technology that will make that marketing easier. But you cannot be expected to overpay for the business because they think that there is room for growth with better marketing. Red flag number 5 is their entire workforce are listed as 1099 contractors. For those unfamiliar, you have W-2 employees and you have 1099 contractors. A W-2 employee is somebody that works for you. You are their employer. They get a paycheck on a consistent, regular basis in exchange for a certain job that is done. You are paying their Social Security tax and their Medicare and all those other wonderful taxes that we pay as employers you're paying on behalf of the employee and you're paying on behalf of the business. A 1099 contractor is not technically an employee. You cannot tell them where to be and when to be there. You cannot ask them to wear a uniform. You cannot be their sole source of income. There's a lot of federal and state guidelines on what a 1099 is versus what a W-2 is. The 1099, the advantage for a business owner is you don't pay the employer taxes. You're also not responsible for withholding that contractor's taxes. They have to go pay their own Social Security and state taxes and all the other stuff. As a business owner, a 1099 contractor is much easier to manage and can be a little bit cheaper from the perspective of you're not paying taxes for them. But there are very strict guidelines in who can be a 1099 versus who has to be a W-2 from an employer perspective. And if that business is not following those rules, they are subject to massive fines from the government if they ever get caught. That aside, you also have to be a little bit concerned as a buyer. If there is a decent sized workforce and they're all 1099 contractors, that also means that they don't have to show up to do any job for you anytime. They're not going to get paid. And yes, in theory, your W-2 workforce could all walk off the job at the same time too. But back to that comment I made about 1099 contractors is usually by law, there's some caveats in there, but they cannot have a sole source of income from one employer. If I'm the employer and that contractor, I'm their sole source of income, there probably shouldn't be a 1099. So the 1099 contractors usually have other people they're also working for. They have a much easier job transitioning to do more work for somebody else than for a W-2 employee to just walk off the job, because in most cases, you are their only source of income. So just keep an eye on that. If you're looking at the expenses and the payroll section is very low and they say, oh yeah, it's great, we do all 1099s. Make sure you understand why that is. There are certain situations where it is completely legal and they're doing everything by the books and it works for that industry or that business. But just make sure you understand that. That would be a red flag to me in a lot of industries. That's the 5 red flags that I'm kind of watching for right now. Those always change over time. I think I've done other videos with red flags in the past. There will be future ones as well as they evolve, as I learn more myself, as I dive a little bit deeper into other businesses and other things pop up. Almost every business is going to have some quirks. There's going to be these flags here and there everywhere along the way. Just because you saw one of these 5 or any other red flag doesn't mean you need to turn around and run. It just means you need to be careful. You need to do a little bit more due diligence and possibly utilize that to negotiate a lower price. Figure out some kind of earn-out situation if you're not comfortable, where the owner doesn't get paid until you've proven certain metrics. Utilize it to your advantage. Don't necessarily run away, but be aware. And if you see too many red flags stacking up, make sure that you're even more careful. What red flags have you seen when looking at businesses? I'd love to hear them in the comments. Let me know. Shoot me an email. Hit me up on social media. Just let me know what other red flags you've seen when you're looking at businesses. And if this has helped you at all, please take a second to hit the subscribe button. Really appreciate it. And I will see you again soon. Cheers.
Thanks for listening to Business Buying for Financial Independence. If you're serious about owning your time and building long-term wealth, make sure to subscribe so you don't miss the next episode.